is a way for banks to keep their customers, keep their deposits. And so you'll see here, it ranges from charging by API call to different apps maybe built on top that would monetize on additional data and insights, or rev share with some of these third parties hooking into the open banking initiatives. And so, yes, banks have our trust right now, and open banking is being forced in Europe, and we're seeing all the big banks have open banking initiatives. But yes, the cost of trust is baked in. DeFi is definitely much more risky. Thank you, Howard. So the second business model that I'm going to talk about in CeFi is card fees. Familiar with broker-dealers, brokerage firms, real estate brokers, but there's pawn brokers, there's yacht brokers, obviously stock brokers, insurance brokers. There's a lot of brokers that we have not cut out yet. So I think you guys have your work cut out for you. And so the financial services industries tend to pay the most for lead generation because they make a lot of money per customer. And so kind of the top 7 industries where you'll see this lead gen and like third party commissions is the insurance industry, a lot of remodeling and home services, legal, education, the credit card companies. So there's a lot of referring websites like bankrate.com or NerdWallet. And then there's also real estate's a huge industry because you're getting such a big loan. If you're refinancing, the brokers will get paid sometimes just to refer a refinance. They'll get paid $10,000. And then the last one is kind of assisted living. So people being placed into homes also will tend to charge for that. And there's a couple large referring websites, as well as there used to just be in-person brokers, I suppose. So I'm going to cover one specific use case of third-party commissions, which I think you guys will find interesting. So targeting online brokerages, our favorite Robinhood. And what I think is interesting about their business model is they moved into an extremely crowded industry with a lot of discount brokerages like Charles Schwab that have a lot of AUM. And they really decided to streamline how they made money and optimize on one particular flow, which was commissions. And so while they do charge for fees for like margin trading and interest on some of their customer deposits, they actually make the most money specifically from payment for order flow. And so this is how they've been able to really enable free trading. And so I would say that they really differentiate themselves by really optimizing for this one revenue stream. So what payment for order flow is that Robinhood actually will send their your orders or the orders in general to market makers and high frequency traders for execution. And they make money on the spread. And so specifically what Robinhood does is they will automatically send your order to their partners that are market makers. And it has to be based on the one that will give you the best execution. And then they have a range of market makers that they use who all promise to pay them the same rebate and commission at the same rate. And so earlier, I think last year, they got in trouble for not working with enough folks. So they've expanded that list of people they work with. So you might be asking, why would people pay for the order flow? So on the left side, you'll see these are kind of the main firms that they route orders to and how much they're paying, how much payment they're getting from each party. And so these market makers are purchasing the order flow because it offers better prices than public exchanges like NASDAQ and trading on the NYSE. They also like to be able to execute their orders off exchange to avoid those fees. And there's less risk associated with the retail flow. So it would allow for better prices. and also allows them to not have to compete with more sophisticated traders. And so you'll see, even though Robinhood has lower assets under management compared to the others and a lower average account size, they're doing pretty well because they have optimized this flow. Most of the others charge for a fixed per share basis, and they decided that they were going to charge for a fixed rate per spread. So you'll see in this chart, the rates are all pretty good, despite having less users and less AUM. And people tend to pay more because they are introducing a new demographic that's different than Charles Schwab, that's different than E-Trade. And you could say that these people offer some diversity, different size trades, different sector preferences, as well as different trading strategies, more or less aggressive. And so this has become quite profitable for these market makers and high frequency traders. So there is a lot of incentive to bring new segments of users to the market and different ways to optimize on making money on those segments. The last model I'm going to talk about is pretty self-explanatory, but it's assets under management, which is probably something you guys will understand straight off the bat. But similar to deposits, there is also a cutthroat battle for assets under management. And so typically these organizations will charge as a percentage of the total market value of assets that they have under management. And the fees will be expressed by basis points. So you'll see this for mutual funds, financial advisors. Believe it or not, older people use financial advisors. And then banks and insurance companies also will have their asset management arms. And then asset managers themselves, which deal in anything from equities to real estate, and then robo-advisors who are trying to automate all of this. And AUM continues to grow. You'll see in this chart through to October 2020, AUM in North America grew, I think by, I'm looking closely, 20%, Japan 25%. So it continues to grow, and people are looking for yield as well. So similar to the big banks, the top asset managers have not changed. It's still the same couple of players. BlackRock has trillions under management, and 80% of the assets they deal with are actually equities and fixed income. So there's not actually that much diversity. Definitely barely any is making it to crypto right now. There's also typically a differentiation between passive management and active management, and there's a general trend towards passive management because some people argue that active managers are not making better returns and just charging you more fees. And so you'll see from this small chart here that the top 20 funds, typically about 66% are just individual independent asset managers, and then the rest come from banks and insurers. So why do we care? It seems like you guys are already seeing some parallels. But regardless of how, we have this incredibly robust legacy financial system. We have fintechs that have promised to bring the revolution. We've also have DeFi that promises to bring the revolution. But there are still a ton of key problems that exist. There are 1.7 billion people in this world that are still unbanked. I mean, I mainly talked about the US today. That don't even get me started with emerging markets. There's all kinds of other models in those countries. We still have financial crises. There is, as you can see, very 0%, almost 0% interest rates from the banks who are turning around and making a ton of money on your dime. And there are high fees, slow transfers, slow settlement, and not everyone has access to capital. And then wealth inequality continues to increase. This is a really interesting chart. It breaks it down by the top 1% versus the top 90% and those in between. And you'll see that the top 1% own over 50% of equities. And that's like the predominant strategy right now. So a lot of people are being left out. It's interesting to see that real estate and pension funds are a little bit more equal, but this is only contributing to inequality because people are being able to invest their money. And though we've made great bounds and leaps with progress in DeFi, we're still missing use cases for everyday people. And so if you look at adoption as value minus friction, we're all very aware of what the friction is right now. Value continues to increase and become more attractive. But if you look at this pyramid, which I love, which shows Maslow's hierarchy of financial needs, cryptos and DeFi is really serving the two boxes in the red, people who are thinking of accumulating wealth and people who are working on financial freedom. Like, don't get me started. There's a ton of money locked up in legacy, focused on the big ticket sizes. And then we've largely ignored people at the bottom who just need basic banking, basic payments, basic transfers of money. And so I end today with saying that CeFi matters because there are still a ton of CeFi segments that are unaddressed by DeFi. I would argue that most of DeFi, as you can see here from this handy dandy market map, targets investment and trading use cases. So options, money markets, exchanges, short-term lending, also to help with trading, getting a bit into insurance. But there are such large segments with a lot of deposits, a lot of AUM left out there, including asset management. We've just scraped the surface. There's banking, payments and settlements. At Stellar, we're really focused on payments, settlements, money transfer to make it really cheap for some of these emerging markets. Lending for things besides trading, like real estate, car loans, student loans, you name it. And then don't even get me into payroll and accounting for small businesses. So I think I'm right on time. I don't know if there's any burning questions, but I hope you found that informative today, and I hope it inspires you to build out on some more use cases.
Thanks, Andrea. This was a fantastic talk. So we have 2 questions at the bottom,
Oh.
but we don't exactly have time. So if you want to drop in your Twitter handle, maybe they can ask
Yes,
you.
my Twitter handle's right on the slide. Feel free to direct message me or tweet me, and I'm happy to answer. Thank you.
All right, thanks, Andrea. We're going to transition to our next talk.